Good morning and welcome to the Killik & Co market update. Brexit Day is finally here and the UK will be leaving the EU at 11 p.m. this evening. Now, what does the market think about this? A good place to look is the FTSE 250 index. Now, the FTSE 250 contains a number of medium-sized and smaller companies which depend on the UK for their fortunes more so than the companies within the FTSE 100 would. So the FTSE 250 can be used as quite a good barometer of sentiment towards the UK economy. So let's have a look at the chart over the last year. You can see some strengthening in the index throughout the latter part of the year as we approached the general election, and that was because the Conservatives were moving ahead in the polls and investors were just hoping for some kind of clarity over Brexit. We then had quite a notable spike upwards in the index when the Conservatives actually won that majority, but since then the index has somewhat dwindled downwards. And perhaps that's because investors are now starting to think about the amount of work that still has to be done. We still need to agree a trade deal with the EU. Now, trade deals between countries can sometimes take years to put in place. We know that Boris Johnson is hoping to have one in place within the next few months. We know he wants to have one there before December, but perhaps investors are slightly worried about how ambitious this is, and perhaps that's the reason why the FTSE 250 index has come down a bit over the last few weeks. The Bank of England also this week did publish some rather negative commentary on the UK economy. They've actually downgraded their growth forecast for the UK economy to just 1.1% per year for the next 3 years. So that was a fairly negative bit of news. However, the Bank of England has held off on reducing interest rates in the UK at the current point in time. They've left interest rates on hold at 0.75%, and I think that can be taken as a small bit of good news. I think that shows that the Bank of England believes that at this current point in time, they don't believe that the UK economy needs further support. So mixed news there for the UK economy, and we'll just have to see how these negotiations over the trade deal play out over the next few weeks. Also this week, the Chinese virus continues to spread, and this morning we have had the reports of the first 2 cases being found within the UK. Last week we highlighted some areas of the market that had seen weakness because of this virus, notably the big hotel chains, the reason being that these hotels have had to give refunds to any customers who had booked to stay within certain areas of China. This week we've seen some weakness in some of the big cruise companies. It was reported earlier this week that 7,000 people on one particular cruise ship had been denied permission to leave the ship at one particular port because it was believed that one person on board had the virus. Now, looking back over the last month at the performance of some of these cruise companies, we have seen quite a lot of weakness here. So this chart here shows the performance of these shares since the beginning of 2020. You can see that Royal Caribbean is down 11%, Norwegian down 6.8%, and Carnival down 13.2%. So these really are quite weak performances, and we'll have to see what the further performance is as this virus continues to spread around the world. One area that has perhaps seen some positive press as a result of the virus is digital payments. A number of articles have been published alleging that if the virus can be spread by the handling of dirty money, then arguably that makes digital payments more attractive. So that's one small silver lining amongst the bad news of this virus. And finally, this week, we've seen some weakness in some of the infrastructure funds that invest in renewable power, specifically funds and investment trusts that invest in wind and solar farms. The reason for this weakness is that a report has been published by Bloomberg New Energy Finance, predicting that the costs of electricity will fall quite significantly over the next few decades. Why is this bad news for wind and solar farms? The reason is that you would value a wind or a solar farm by calculating the amount of electricity you expect that farm to generate over the next few decades, and then you would multiply that by the price that you expect this electricity to be sold for. If it does turn out that the prices of electricity will fall significantly over the next few decades, then that implies that wind farms and solar farms today should perhaps be valued at less than they currently are. So this report was published early this week. Here's a quote which we've taken from the report. Turbine costs are down by 40% since 2010, while machine efficiency is up, and the use of sensors and smart data helps to optimize operational efficiency and reduce costs. We expect the cost of wind energy to drop another 36% by 2030 and 48% by 2050. So if this turns out to be true, it's great news for us as the consumer, but it could be bad news for wind and solar farms because it will impact their current valuations. So this was published early this week. We have seen weakness in some of the renewable infrastructure fund shares, and we are waiting for fund managers to publish some commentary on this issue and about how they will predict power prices over the coming years. So that's something that we're certainly keeping an eye on over the next few days. And looking at the week ahead, we've got results out from some of the big oil companies, BP and Total, and we've also got results out from Walt Disney. That's it from us. Have a great weekend, and we'll see you next Friday.